All right. So, like I said, I told you the other time, we'll be starting from this chapter of the book. I feel that it is a logical progression from where we left off in the previous syllabus, which is the AS syllabus. Um, this is a recap of the AS syllabus, chapter 5. We talked about business finance, and then we looked at the need for finance. Why does a business need finance? We've discussed several reasons why a business would need finance. To purchase assets, obviously, the business needs some machinery to run, may need vehicles, may need other assets, buildings, and finance will make these things available to the business. So we discussed this. We also talked about working capital, which is very important. We said that working capital is a measure of the amount of money that is available to a business to that pays its day-to-day expenses. So a business would have day-to-day expenses like buying fuel, paying wages, etc. And its working capital will enable the business to do this. Then we looked at sources of finance, we looked at business ownership. The various forms of business ownership have various sources of finance available to it. So the sources of finance available to a sole trader are different from the sources of finance available to, say, a public limited liability company that can sell shares. A sole trader cannot sell shares. So depending on the legal structure of the business, it has various sources of finance available to that particular business. We also talked about the factors affecting sources of finance. We looked at cash flow forecasting. And then in 5.4, we looked at cost information, um, approaches to costing, uses of cost information. We talked about break-even analysis, where we talked about contribution costing and all that. And lastly, we talked about budgets, um, meaning of a budget, the purpose of a budget. And then we looked at budget variances and what it means for a budget to be in variance. All right. In this level, we're going to start talking about financial statements. That's what we're going to talk about today. Today, I hope we can finish talking about the first one, 10.1.1, which is a statement of profits or loss. And then we'll look at the others later. But a quick overview of our content in chapter 10, we'll look at financial statements, which is the first one. Then we'll look at how to analyze published accounts, published financial statements. We are going to do this with some mathematical ratios. We're going to look at liquidity ratio, profitability ratios, financial efficiency ratios, and some other ratios. And these ratios help us to analyze financial statements or published accounts. And then you're going to also look at investment appraisals. There's some mathematics that finance people use to appraise investment and to determine whether it is it's going to be a good investment of the business's resources or not. And then in the last unit, we're going to look at finance and accounting strategy. All right, so let's start first of all with financial statements. All right, so what is a financial statement? What is a financial statement? The definition is not provided in your textbook. You're not expected to define it, but I feel that it is best we start from there by getting understanding of what a financial statement is. So a financial statement is a report, or we can say it's a document that presents the financial performance or the financial position of a business for a certain period, and it is usually 1 year. A financial statement is a document, or we can say it is a report that presents the financial performance and position of a business for a certain period. So um, I'd like to draw parallels with the report of a student. If you go through a particular grade, say grade 9 or grade 10, at the end of that year, you are presented with a report. A business has also gone through a financial year, and at the end of the year, the business must produce a report, a financial report that would tell certain people the performance of the business. So, like your parents would want to see your performance at the end of a particular grade or at the end of a particular year. The parents of the business would also want to see the report of the business. And who are the parents of the business? The owners of the business. So if it is a share, a sole trader, the sole trader is keeping records of the business. All the sales of the business are recorded. All the expenses of the business are recorded. And at the end of the period, he wants to know, did I do well financially or not? Just like a parent would want to know, did my daughter or did my son do well academically or not? So the first user of the report is well, not necessarily the parents, but the student himself. If you are a student and you complete an academic year, and you are issued with a report, your report is telling you about your performance for that grade. So you are the first user of that report. So a business also wants to see its performance at the end of the year, and these financial statements will tell the business whether it has performed well or it needs to improve in certain areas. There are other uses of the financial statement, and we'll talk about them later. So, like I said, a student uses the report to determine whether she is doing well or not. The parents who are financing the education also will look at the report and determine whether they are making a good investment or not. So, a business would also have several uses of the financial statement. The business owners would want to know whether the business is doing well. The employees who are working for the company would want to know, is the business doing well? Should we negotiate for better pay? The government would want to know whether the business is doing well because the government also has an interest in the business. All right. So we talked about business stakeholders in the AS level, and all these stakeholders at the end of the year, at the end of a period, would want to know whether the business is doing well or not. And the financial statement is a document that will inform the users of the financial statement whether the business is doing well or not. So the first financial statement that we're going to start with is the statement of profit or loss. So as the name implies, this statement, this financial statement, this financial report is going to inform the business or inform the users of the statement whether the business has made a profit or a loss. All right, so let's jump in. So the first thing that we would want to know, interestingly, the first thing on this slide is talking about IFRS. The first point says that public companies in the UK and in many countries must follow the International Financial Reporting Standards. We know what a financial statement is, but what is IFRS? IFRS is guidelines or a code that a public company must follow in preparing its financial reports. I'll say that again. These are guidelines, international financial reporting standards, are international guidelines that a business, particularly a public company, must follow in preparing its financial statements. Why is it important? That's the second point on the slide. It is important because the international financial reporting standards promote global consistency in financial reporting. All right. And this global consistency is important because that's the third point. It leads to standardization and it facilitates easier comparison and analysis across companies. What are we trying to say? All that we are trying to say is that when businesses prepare financial statements, they do not do it in an arbitrary manner. They go by laid down guidelines and principles, or you can even say rules that guide them in preparing these financial reports. So, like I said, it is not done in an arbitrary manner, but the accountant will go through or follow laid down procedure, laid down steps, guidelines, or rules in preparing the financial report. And it is important because if financial reports across businesses, across countries, across continents are standardized. They can be compared, and it helps those who are looking at the financial statement to make easier comparison and analysis of the financial statement. So that's the first thing that we have to note about preparing financial statements. We're going to look at different types of financial statements. We will start with number one, the statement of profit or loss, which we are looking at today in this lesson. And then in our next lesson, we'll look at the statement of financial position. The statement of financial position previously used to be called the balance sheet. And then the first one, the statement of profit and loss, is also called the income statement. All right. So that's the first thing that we will look at, the statement of profit or loss. All right. So what is it? What is the statement of profit or loss? Like I said, the name gives it away. It immediately tells us it's a statement that will tell us whether the business is making a profit or loss at the end of a period. And it's usually at the end of a year, but this statement can also be prepared at the end of the month so that for the month of January, February, March, or in any particular month, the business can determine whether it made a profit in that particular month or not. It can also be prepared at the end of a quarter or half yearly, that is at the end of 6 months. So what is it? The statement of profit or loss is a financial statement showing a business's sales revenue over a trading period and all the relevant costs generated to earn that revenue. All right. So that's a very important starting point. The statement of profit or loss will always start with the business's sales revenue. It will start with the business's sales revenue, and then it will compare the sales revenue with all the relevant costs associated with generating that revenue. So essentially, if a business knows how much its revenue is and it knows all the costs that it has incurred to generate that revenue, it can subtract the costs from the revenue and determine whether it made a surplus. And the surplus is called a profit, or whether the costs were more than the revenue. If the cost is more than the revenue, it means that the business made a loss. So take any business. It can be a school, a water bottle manufacturing company, a mobile phone manufacturing company. If its sales revenue is greater than its cost, then it makes a profit. However, if its cost, that is the cost, the expenses that is incurred to run the business and to generate the revenue, if these costs or expenses are greater than the sales revenue, then the business is making a loss. So it's a balancing act. Every business must keep an eye on its sales and it must keep an eye on its costs. We talked about cost already last time in the AS level. So we know into details these costs and why it is important to keep proper cost information. We talked about all of that. Now, what we are saying is that at the end of a period, at the end of a year, at the end of the month, a business must strike the balance. How much did it generate in revenue, and how much did it cost the business in generating those revenues? And then it subtracts these costs from the revenue and determines whether it made a profit or a loss. There are different types of profit that we will look at when we look at the statement of profit or loss. The first type of profit is called the gross profit, the gross profit. Now, this is a type of profit that is calculated by deducting the cost of sales. We already know what cost of sales is, but we will revise it once again. And these costs are costs such as the materials. If we are producing, if we are manufacturing bottles of water, the materials, the cost of the material, the cost of the bottle, the cost of the label, the cost of the shop labor, the floor labor, the labor in the manufacturing, um, in the factory, the factory labor. All these are costs, direct costs that must be subtracted from our sales. All right. And when we do that, when we take our direct cost from the sales, we generate or we produce our gross profit. There are other costs that a business incurs. For instance, costs that are not direct. Remember, we said that direct cost is what can be traced to the product. So on my desk, I have a pen. In the pen, I have a barrel of ink in my pen. The ink in the pen costs the pen manufacturing company money. The plastic that is used to produce the case, the housing of the pen, cost money. The labor that worked directly on manufacturing the pen also took some money. They were paid some wages. All these can be directly traced to the pen that I'm having or that I'm holding. And these are direct costs. Now, there are other costs that a business will incur that cannot be traced directly to the pen that is on my desk. The costs, for instance, the salary of the factory manager, the salary of the administration people in the office cannot be traced to the product. These are not direct costs. All right. So there are other costs that must be deducted from the sales revenue. These are called operating profits. All right. These are called these other costs are deducted from the gross profit to generate the operating profit. All right. So it says the operating profit is the revenue less cost of sales and expenses. In gross profit, it is just the revenue minus the cost of sales. The cost of sales. That is the cost incurred in producing the product. But in operating profit, it is not just cost of sales, but cost of sales and cost of other expenses. All right. Example is rent. The rent that is paid for the factory is an expense that needs to be deducted from the sales. Rates also is an expense that must be deducted. So let me use an example of a school. In a school, the students pay their fees, and this is revenue for the business, for the school. Now, in generating these revenues, the school pays the teachers. The school buys board markers. These are all direct expenses that the school must deduct from its revenue. However, there are other expenses that the school incurs. For instance, running buses. The school runs buses, it buys fuel, it pays the salary of the principal. The principal is not directly involved in generating the revenue. The teachers are involved in generating the revenue. However, the principal's salary is also a cost to the business that must be deducted, but it is not deducted as cost of sales. It is rather deducted as other expenses. So administrative and other expenses is now deducted, and then we generate the operating profit. The third type of profit is the profit for the year. All right, what is it? It said this measure of profit takes into account a business's income from its sources, trading and non-trading, and the full range of costs incurred, including taxes on profits and interest charges. I'll read it again. So this measure of profit takes into account a business's income from all its sources, that is, its trading and non-trading, and then the full range of costs incurred, including taxes on profits and interest charges. Let's take the example of a school, for instance. The school takes school fees from the children. This is the main source of revenue for the school or to the school. But there are other things that the school does that also gives the school revenue. For instance, the school has a canteen. The canteen is not the reason why the school is operating. The canteen is just some other service that the school provides to the students. This canteen is generating revenue. So at the end of the year, all these non-trading, we call these activities non-trading activities. The main activity of a school is to provide educational services. If we are a mobile phone company, our main activity, which is our trading activity, is to manufacture mobile phones. If we are a pen manufacturing company, our main activity is to manufacture pens. If we are a water bottle manufacturing company, our main activity is to manufacture water bottles. However, if there are any other activities, for instance, for a school, it has a canteen. It also provides bus services to the students. These activities are non-trading activities because that is not the main reason why the school is in existence. Let's take a water bottle company. The water bottle company sells water bottles or sells bottles of water to earn its revenue. However, this company has huge amounts of cash that is not using. So it decides to use this cash in some other investments. Say, put it in a bank for the bank to give the business some interest on the money. This interest is income to the business. However, that is not the main reason why the water bottle company is in existence. So this income that is generated from investing its cash is called income from non-trading activities, as we have here. So all these income from non-trading activities must be added to the profits, to the operating profits to get the profit of the year. The other side of the coin is that if there are any activities that also take money away from the business, for instance, the business went for a loan to buy an asset, and the business is paying interest on this loan. All right, we cannot deduct this interest here at the operating profits section because it is not an activity, it is not the main activity for which the business was set up. Therefore, if there are other non-trading activities that the business is involved in, that is giving the business a profit, these non-trading activities, these income from non-trading activities are added to get a profit for the year, or they are subtracted to get a profit of the year. Here also, taxes are also subtracted from profits to get from the operating profits to get the profits of the year. Let me go over again. Perhaps I'm not very clear. So what I'm saying is that there are three types of profits that we are going to look at. We're going to look at gross profit, we are going to look at operating profit, and then we are going to look at the profit of the year. What do we mean by gross profit? Gross profit is when we subtract the cost of sales from revenue. The cost of sales from revenue. And what is cost of sales? These are costs such as direct material cost, direct labor cost, and other direct costs that can be traced to the product. So if we are selling a bottle of water for 1 real, what is the cost of the bottle of water? The cost of the bottle of water is the cost of the bottle itself without the water in the bottle, the cost of the label, the cost of the lid, all these costs may amount to say 50 halala. So if we deduct 1 real of 50 halala from 1 real, it gives us our gross profits. It gives us our gross profits. So that is what we mean by gross profits. So gross profit is our direct cost subtracted from our revenue. And then there is operating profit, other costs that are not direct costs. So cost of sales, plus other costs like expenses, rent, etc. These are other costs. These are other costs that must be deducted from gross profits to get the operating profit. And then from the operating profit, we deduct other non-trading income and expenses. We deduct other non-trading income. If it is an income, we add it. If it's an expense, we deduct it to get the profits of the year. All right. So let's look at how the statement of profit or loss is arranged or prepared. Like I said, we start from the revenue, the business's revenue from sales. So how many water bottles did we sell? We sold 500,000 water bottles, and each bottle cost 2 real. That means the revenue of the business is the 500,000 bottles that we sold times 2 real. That will give us what? 1 million. And then we deduct, sorry, let me move step by step so that you're not confused. Then we deduct the cost of sales. So costs such as the raw material cost of the bottle itself, cost of fuel in running our generators for the plant or for the factory, any cost that can be directly traced to the product that we made, all right, is called the cost of sales. And these are also called direct costs. These are also called direct costs. And then we deduct well, deducting our direct cost will give us the gross profit. So our revenue minus the cost of sales or the direct cost will give us our gross profit. Then we deduct other costs. So other costs or other expenses, such as the rent for the factory, the manager's salary, administrative staff salary, etc. After we deduct these expenses, it gives us the operating profit. Why do we call it operating profit? Because we have deducted all the expenses associated with operating our business. All the expenses associated with operating our business. All the other expenses, all the other revenues that are not associated with our main business are not deducted or added here. That's the next stage. The next stage is to deduct any interest that the business pays or any interest that the business receives. So like I cited in a previous example, if we have some cash that we are not using and we decide to buy treasury bills or we decide to put that money in a bank, it is not our main business. So we don't add it in our operating profit. These are other revenues or other costs that the business is incurring, which is not associated with its main business. All right. Once these interests are added or deducted, then we can calculate the profit of the year. Also, here, tax to the government is also deducted, and that will give us the profit of the year. So very straightforward. Very straightforward. We start with the revenue, our revenue. We deduct our cost. That will give us our gross profit. From our gross profit, we deduct other expenses which are not direct. So indirect expenses are also deducted, and then that will give us the operating profit. And from the operating profit, we add any interest that we have received, deduct any interest that we have paid, deduct tax to the government, and this will give us our profits for the year. This will give us our profits for the year. So let's go through it again. Oh, okay, there's a note here before we go to the next slide. The note here says that note, negative figures are normally shown in brackets on financial statements. So instead of representing it by a negative sign, it can also be represented by putting the figure in brackets, and that tells you that it's a deduction or it is a negative number. All right. So any figure that is shown in brackets on a financial statement is a negative number. Number two, the statement usually has three main sections. Number one, gross profit is calculated, which we have here. And then number two, operating profits is calculated, which is what we have here. And then number three, the profit of the year is calculated, which is what we have here. All right. The content of the statement of profit or loss. These are all the contents that we talked about here. All right. So let's look at it. So figure 10.1, which is the previous figure, illustrates a typical profit or loss statement. And like we said, negative figures are shown in brackets. So the first thing that we calculated is the gross profit. The second, we calculated the operating profit. And then the profit of the year is also calculated. And how is the profit of the year calculated? Number one, it says it is arrived at by deducting the amount of tax payable for the year. So I mentioned tax here, that taxation here is deducted from the operating profit to get the profit of the year. Taxation goes to the government. And then the profit of the year figure shows the net amount that has been earned for shareholders. So after all these costs are deducted, all these expenses are deducted, and tax to the government is also deducted, the final amount, which is the profit of the year, represents the amount that goes to shareholders. Now, the business would have to decide whether to pay shareholders a dividend, or it will decide whether to retain the profits into the business. So not every year's profit is given out to shareholders. Not every year's profit is distributed to shareholders. Sometimes the business takes a decision that this year's profit, we will distribute part of the profit to shareholders, and we will retain some of the profits in the business so that we can use it to expand the business or use it for other purposes. All right. And then the last point says that if it's a negative figure, that is all costs and expenses, if it's a negative figure, that is costs and expenses exceed revenue for the year, as in the case of Rolls-Royce. All right, so we'll look at that case study and then we'll see how Rolls-Royce made a loss for that particular year. All right, another very important thing that you have to note is that public companies are required by law to publish their statements, their financial statements. Public companies are required by law. So remember, we talked about the different types of business ownership. So sole traders are not required by law to publish their accounts. Um, Private limited companies are not required by law to publish their accounts. Partnerships are not required by law to publish their accounts, but public limited companies are required by law to publish their accounts because the public has invested its money into such businesses. So we take a business like Apple or maybe Samsung or some of these big companies that are public companies. These companies have taken monies from the public. They have sold shares to the members of the general public, and they are required by law to publish their accounts so that the public will see how the business is doing. But the public will scrutinize the business and use the information available in the statement of in the financial statement to determine whether they are getting value for their money or it is a good business that they have invested in. So they are required by law to publish their account. And here it says that this means that the accounts are available for the scrutiny not only by the owners, that is the shareholders, but also your competitors, potential investors, and banks are also seeing your business performance. So it's like publishing the report of um, 10th graders who write the IG on a public space, in a public notice, so that everybody can see. Other schools are seeing your results. Other students from other schools are looking at your results because you took a public examination, an external examination, and we want to know whether you did well in that exam or not. So public companies, don't forget, are required by law to publish their accounts. The second point here to note here is that public companies usually supply no more detail than is required by law. So apart from the details that they are expected to publish, which is required by law, they would try to include as little information as possible because your competitors are looking at this information. And if you give extra information which is not required by the law, you are actually selling some of your trade secrets, or you are giving yourself out to your competitors. And then the last point says that the accounts of public limited companies also contain notes giving further details of the figures included in the statement of profit or loss. So I want you to take an interest in the public accounts published by certain companies. Take any company at all and download from the internet their latest financial statements. It can be a company in Saudi Arabia, a company in the UK or America, but a public company. Download their financial statements and take a look at their income statements or the statement of profit or loss and determine whether they are making a profit or they are making a loss. All right.
Okay, I'll do that. I'll try Apple.
All right. All right. Do that. All right. So let's look at this case study. Give me a minute. I think someone is ringing the door. Give me a minute. Let me check. All right. So let's look at this case study on Rolls-Royce. I think it's on, let me check the page. Hmm. It's on page 432, 432. Rolls-Royce PLC, Public Limited Company. Rolls-Royce PLC, Public Limited Company, on page 431, actually. Page 431. So let me read. It says that Rolls-Royce Holdings is one of UK's best companies and employed 50,000 mainly highly skilled people in 2020. Rolls-Royce Holdings is one of the UK's best known companies and employed quite a lot of people, 50,000, and it says mainly highly skilled people in 2020. It manufactures engines for aircrafts, ships, and more general business use. It spends heavily on researching and developing new products, and is the world's second largest manufacturer of aircraft engines. And it goes on to say that it sells its products throughout the world for commercial and military use. Rolls-Royce operates joint ventures with companies in Germany. Rolls-Royce Holdings PLC statement of profit or loss is shown in a summarized table, is shown in summarized form in table 10.1. All right, so let me go back to the slides. I have the table on the slide. Yes. So this is Rolls-Royce statement of profit or loss. Like I said, we will begin always with revenue. Is that okay? So they are manufacturing engines. And for the year 2019, we can see the year in millions of pounds. And for the year 2018, in millions of pounds also, we can see the business's revenue for 2019 and 2018. All right. For 2019, it means that this revenue is not 16,587. This revenue is 16 because it says it's millions of pounds here. This is 16 billion 587 million pounds. I hope you understand it.
Yes, sir.
Yes, and then in 2018, its revenue is 15 billion 729. So there's an increase in revenue from 2018 to 2019. Then we look at the cost of sales. Now it is manufacturing engines, engines for ships, engines for airplanes. So what would it be? What will be the cost of sales? These are the parts that form the engines, all right? All these metallic stuff, all these electronic stuff, all the wires, these are its direct material, all right? Then it will also have the highly skilled people who work on these engines, their wages, all right? So the engineers who assemble the engines, who design the engines, etc., will also be part of the cost of sales. All right. So the cost of the materials in making the engines, the cost of the wages that is paid to the engineers who manufacture and design these engines, and other direct material costs or other direct costs will form the cost of sales. All right. So it is put in brackets, meaning that it's a negative figure. All right. Or it is subtracted from the revenue. So in 2018, its revenue is 15 billion 729 million pounds. And this is its cost of sales. It's well, let's work with the thousands, but we know that the figures are actually in millions. So let's work with the thousands. So it's 14,531 here, which is the cost of sales. The cost of sales increased in 2019 to 15,645. Well, to be fair, you can see an increase in revenue also. So the revenue here is 15,000 for 2018, 15,729, and the revenue in 2019 increased to 16,587. All right. Then the gross profit can be calculated. Remember, we said the gross profit is the revenue minus the cost of sales. So the gross profit for 2019 was higher than the gross profit in 2019. The gross profit in 2018 is 1,198,000,000 or 1,198, and the gross profit in 2019 is 942. What do you think accounts for a reduction in the gross profit, even though they earned more revenue in 2019, they are getting a smaller profit compared to the profits they earned in 2018. What do you think accounts for this?
Could you ask me the question again?
Yeah, so my question is, the revenue in 2018 is 15,728, which is more in 2019. However, even though the revenue is more in 2019, the gross profit is less compared to the gross profit in 2018. And my question is, what is accounting for this reduction in gross profits from 2018 to 2019? What do you think?
I don't know.
Oh, it's very simple. There are three numbers here. There's a revenue, there's the revenue, there is the cost of sales, and then there is the gross profit, right? Revenue, cost of sales, gross profit. In one year, the gross profit is higher than another year, even though the profits, I mean, the revenue in that particular year is higher than the revenue in the previous year. So this probably is accounting for the reason why the cost of sales is increasing in this year. The cost of sales is increasing in 2019. Do you understand what I mean?
A little bit.
All right, let me take it again. So what I'm saying is that we are looking at the profits of Rolls-Royce company. They manufacture engines. All right. It's a big company. They employ 50,000 people, and these 50,000 people are usually very highly skilled people. And we are looking at their revenue in 2018. It is 15,000. Let's work with the thousands, like I said. It's 15,000. And the revenue increases to 16,587 in the next year. However, in the next year, look at their profits. The profit has reduced from 1,198 to 942 here. And I'm saying that the reason is because their cost is increasing. Even though the revenue has increased here, the cost is also increasing. The cost increased from 14,531 to 15,000 here, which is accounting for why there is less revenue. Anyway, that is not the question. Let's go through the question. Let's go through the financial statement and then look at the question. Then, after they calculated the gross profits, they subtracted the cost of research and development expenses. Now, these are expenses that are not directly related to the engines that they are selling. Therefore, it is not deducted here as cost of sales. Now, they are business expenses. It is part of the business operations, but it is not a direct cost. So the cost of research and development, other expenses, maybe the cost of factory managers, the cost of insurance, etc., are also deducted. And it's supposed to give us the operating profits, right? But here they are making a loss of 852 million. And in 2018 also, they made a loss of 1,161. Then they added profits from other sources. Remember, we said that profits from other sources that are not related to the business is not added to the operating profit, but is added here to get the profit of the year. All right. So there are other profits from other sources, which is 139 here and 358 here is added. And then finance income that is interest received. Perhaps they have some huge bank accounts that is earning interest from the bank. This is not the operation of the business, so it is not added to the operating profit or the operating loss. It is separated and it is deducted in a separate line to get the loss or the profit for the year. Unfortunately for this business, they are making losses in 2018. The loss in 2018 is bigger than the loss in 2019. Let's look at the question. The question is, analyze one reason why Rolls-Royce employees may be extremely concerned about the company's financial performance over these 2 years. That's the first question. Analyze one reason why Rolls-Royce employees may be extremely concerned. Now, this is the company they work for. The company they work for is making huge losses. Why should the employees be concerned? Remember, we said that there are various users of the financial statement. The financial statement is used by the business itself. The financial statement is used by a bank if the business wants to go and take a loan. The financial statement is used by the employees if they want to know how well the business is doing and whether they should agitate for more pay. Now, this is a business from its financial statement is making losses. They are even making operating losses, and they're making losses for the year. Why should the employees be concerned? What do you think?
Because their pay could get cut.
Very good. Because they could get pay cuts. What else? What else apart from pay cuts?
Uh, some of them could get laid off.
Yes, because they could also be laid off. All right. So in answering this question, you have to expand. You shouldn't give a one-line sentence like that. You have to expand and explain yourself. All right. But that is correct. That's basically correct. All right. And then question number two, evaluate whether or not Rolls-Royce shareholders would have been pleased with the company's financial performance in 2019. What do you think?
This question, I prefer to write it, then maybe I can send it as work.
Okay, all right. All right. So you can do both one and two, and then after you write it out, you can send it to me. Let me have a look at it. And then I will send you what the examiners expect as a suggested answer also.
Okay, okay.
All right. All right. All right. So let's continue. I want us to finish with the statement of profit or loss today. All right, so let's look at how a business might use its profits. Now, from the previous slide, we can see that this business is not making any profits. All right, the shareholders of Rolls-Royce may not be very happy with the performance of the business because the business is making very substantial losses. All right, but in the case where a business is making profits, let's look at how the business can utilize its profits. Number one, we have what we call distributed profits. These are profits that are distributed to the shareholders, and their profits, when distributed to shareholders, are called dividends. It means dividends have been paid, or the profits can be retained in the business. All right, what we call retained profits or retained earnings. And these retained earnings are retained for business investments, such as the purchase of an asset for future use. All right, so there are two ways in which profits could be utilized. And the first point says that profit utilization is a crucial business decision categorized into two uses. The first use is distributed profits, where profits are distributed to the shareholders as dividends, or number two, where profits are retained in the business. Some business would do both of them. They can decide to distribute a part of the profits to shareholders and keep a part, say 50% distribution to shareholders and retain 50% in the business. The second point here says that profit distribution should balance short-term shareholder satisfaction with long-term business growth. What does that mean? If you are a business that is um, has has an objective of growing the business so that it becomes, say, a market leader or growing the position of the business in the market, that means that you need to invest in the business. When we talked about sources of finance in the AS level, we said that why does a business need finance? A business needs finance so that it can grow. So if you are a business that is seeking to grow, then you would want to uh, balance distributing your profit to shareholders as against your long-term ambition of growth so that you don't distribute all your profits whilst you are expecting that you will grow. To grow, you need to invest into the business, and profit is what you use to invest to grow into the business. So you don't distribute all your profits. And then the third point says that distributing a high portion of profits may keep the business owners happy in the short term, but might not be in the interest of long-term investments. Very simple point. So what we are saying is that if you want to grow, you don't distribute all your profit to your shareholders because you want to keep them happy. You are actually keeping yourself from growing if you distribute all your profits. All right, and then let's look at some of the factors that can cause changes in financial in the statement of profit or loss in the financial statement, some of the factors that can cause amendment or changes in the statement of profit or loss. Number one is the change in the selling price. So we are selling bottles of water. It is at 1 real. That means that if we sell 50 bottles, we make 50 real. If we sell 500 bottles, 500 real. If we sell 5,000 bottles, we are making 5,000. But if we increase the cost of the bottle to 1 real 50 halala, that is 1.5, that means that our revenue is also going to change. So if we increase to 1.5 and we are selling 5,000 bottles, that means that we are not making 5,000 real anymore. We are now making 7,500. That is 1.5 times um, 5,000. 1.5 times the 5,000 bottles that we are selling. Previously, our price was 1. So 1 times 5,000 is 5,000. But if we increase our price to 1.5, that means that we are going to increase our revenue. And once revenue increases, it means that we are going to cause a change, an amendment in the statement of profit or loss. What part of the statement of profit or loss is going to change? Is going to change our revenue. Once our revenue changes, it is also going to change our cost of sales. If our cost of sales change and our revenue has also changed, that means it's going to change our gross profit and it's going to change our operating profit, is going to change our profit for the year. All right. So it has a cascading effect. When prices change, it's going to increase our gross profit, is going to increase our operating profit, is going to increase our how do you call it? Our profit for the year. That is if the price change, if the price change is positive. All right. So the first point says that changes in selling price. Price elasticity of demand determines the effect of price changes on sales revenue. Businesses may raise price if demand is price inelastic. When price is inelastic, it means that it has no effects on the quantity that is demanded. That is price inelastic. If the price is elastic, it means that when the price change, the quantity that is demanded or the quantity that is sold is also going to reduce. All right. But if the price is inelastic and we increase the price, it means that it has no or it is less sensitive to price changes and it has less effect on 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 um, on sales. An example is water, bottle of water. If they increase the price to 5 real now, you're not going to say I'm buying less water because the price has increased. So it is a bit price inelastic. Even though you're going to manage how you waste the water, but it's not going to really affect how much of the product that you buy. All right. So a change in selling price can cause a change in the statement of profit or loss. What else can cause a change in the statement of profit or loss? A change in the volume of products sold, a change in the volume of products sold. So selling 5,000 is different, obviously, from selling 10,000. Selling 10,000 means that we are selling more than our usual quantity, and more sales means that we are going to make more revenue. More sales means that we're going to make revenue if our price remains the same. And then the third factor that can cause a change in the statement of profit or loss is a change in costs. A change in costs. So we are selling bottles of water, but the raw materials that we are buying to manufacture the bottle is increasing. That's the plastic. Cost of plastic is increasing. So if there's a change in cost, it's going to affect our profits. All right. A change in cost is going to affect our profit. If the cost is increasing, that means that our profit is reducing if our price remains the same. If the cost is reducing, that means that our profit is increasing. All right. And then there's a note down here that says that adjusting product sales can alter business costs, including cost of sales and distribution cost. Adjusting product sales can alter business costs. We'll look at an example and we'll know exactly what we mean by that. That when we change the quantity, all right, uh, or um, or when we change the cost here it says adjusting product sales can alter business cost. Adjusting product sales can, all right. So when we increase the sales or when we decrease the sales, it has an effect on our costs. All right. Direct costs, for instance, or cost of sales will reduce when our product sales also reduce. So we'll look at that when we look at this example, but I don't think we have enough time to look at it. The next case study, which is West Kericho Estate, which is a tea plantation in Kenya, we are going to look at the effect of these changes in selling price, changes in the volume of product that is sold, and the change in cost in this example, in this West Kericho example. So there are some original figures, and then there are some amended figures in revenue, in the course that we are going to look at and examine the effect that these changes have on the profits and the operating profits and also the profits of the year. But we don't have enough time, so we'll look at that on Saturday. So on Saturday we'll begin our lesson from this case study, which is the West Bericho plantation in Kenya. Any questions so far?
No question.
All right. So see you on Saturday.